For generations, farmland has been seen as pretty much one of the safest investments you can make. I mean, it's real, it's tangible, it produces stuff we all need, and, well, like the old saying goes, they're not making any more of it. But what if that idea, that bedrock belief, is about to get seriously challenged? Okay, let's dive into a really bold, and honestly, for some people, a pretty startling prediction about where farmland values are headed. And there it is. Right there, that's the core idea we're going to unpack. We're not talking about a little dip here, few percentage points. No, this is a forecast for a correction of over 50%. This prediction comes straight from an analyst named Trent Klarenbach, who looks at markets through a very specific lens. So the firm behind this is Klarenbach Research, and their whole approach is about stripping away the day-to-day noise, the news headlines, market sentiment, and just focusing purely on historical patterns and trends. And the framework they use to do this? It's called technical analysis.
So what even is technical analysis? Well, instead of digging into things like crop yields or weather reports or company financials, what we'd call the fundamentals, it focuses almost entirely on the price charts. The basic idea is that all the known information is already baked into the price, and that human behavior, our psychology, creates patterns that tend to repeat over and over again.
Okay, so that brings us to the big idea, the philosophical foundation of this whole prediction. It's not really about just one chart or one pattern. It's about a belief in the unavoidable rhythm of markets. It is all about cycles. And here is the absolute crucial point. Klarenbach's entire argument hinges on this. Farmland is not special. It's not an exception to the rule. Despite all its unique qualities, he believes it's subject to the exact same historical boom and bust cycles that we see in stocks, in commodities, in pretty much every other market out there.
Now, what's really fascinating here is that these cycles, they aren't some new radical idea. Economists have been documenting them for more than 100 years. You have your shorter business cycles, your medium-term commodity cycles, and even these really long waves, sometimes called Kondratieff waves, that can span an entire lifetime. The theory here is that we are simply living in one phase of a much, much larger pattern.
All right, so if a massive correction is just part of a cycle, how does it actually play out? Well, according to this analysis, it's not some sudden, out-of-the-blue event. It's a predictable, two-stage process. Let's break down exactly how that's supposed to work.
So it starts with what's called a liquidity crisis. And that's a fancy way of saying a cash flow problem. Margins get squeezed super tight, profits start to vanish, and it just gets harder and harder to pay the bills and make those debt payments. Now, if that pain goes on long enough, it triggers stage 2, a balance sheet crisis. And that's when the value of the asset itself, the land, starts to drop. Banks get nervous and stop lending, and the whole problem just snowballs.
Right. A mechanism like that doesn't just kick off on its own. It needs a trigger, or what the analysis calls a catalyst. And Klarenbach actually identifies 7 potential catalysts that could get this whole two-crisis progression rolling.
The analysis points to a whole bunch of potential issues. We're going to walk through some of the biggest ones. And they cover everything from classic economic factors like interest rates and crop prices to massive societal shifts like demographics, government policy, and even long-term population trends. The idea is that any one of these, or a combination of them, could be the spark that lights the fuse.
Let's start with this rent-to-loan ratio idea. Right now, the annual cost just to finance a new land purchase, your principal and interest, can be somewhere around $200 to $240 an acre. But the income you can actually get from renting that same acre out is only about $100 to $150. That is a huge gap. The argument is that this just isn't sustainable. Something has to give. Either rents have to absolutely skyrocket, or land prices have to come down to close that gap.
In this slide just perfectly illustrates the raw power of interest rates. Let's say you can afford a certain monthly payment. At a 4% interest rate, that payment gets you an $800,000 loan. But if rates jump to 5%, that same payment only gets you a $730,000 loan. Your purchasing power just dropped by 70 grand. Go up to 6% and you can now afford $130,000 less. It's simple math. Higher rates directly shrink how much buyers can pay for assets, and that puts downward pressure on prices.
Now, this number, 1 to 3%, represents the current rate of return you'd get from rental income if you bought new farmland today. Just 1 to 3%. Frankly, that's not very competitive. As interest rates rise on safer investments like government bonds, big institutional investors might start looking at farmland and think, you know what, that's not worth the risk, and that could dry up a major source of demand.
Here's another powerful catalyst: demographics. A massive amount of farmland is currently owned by the baby boomer generation. As this wealth gets passed on to their kids, many of whom aren't farmers and have no real ties to the land, there's a very real possibility that a flood of new supply could hit the market as these heirs decide to cash out and sell.
Then you've got government policy. This is a wild one. According to Klarenbach's source, a staggering 40% of all corn grown in the United States goes toward making ethanol. And that demand is basically created by a government mandate. So, what happens if the political winds shift and that mandate gets reduced or, eliminated entirely? You could see a massive corn surplus overnight, which would crash commodity prices and send shockwaves through the whole ag economy. And finally, we have the longest-term catalyst of them all, the year 2077. This is one of the years that many researchers predict the world will actually hit its peak population. After that point, declining birth rates pretty much everywhere suggest that the global population will start to shrink. And fewer people? Well, it means less demand for food in the very, very long run.
So, after looking at the theory, the mechanism, and all those potential triggers, what's the big takeaway here? What does this all mean right now? Let's try to pull it all together.
So as we've seen, there are a whole bunch of powerful forces, from economics to demographics, that this analysis believes are all pointing in the same direction. The core argument is that the combined weight of all these factors makes a major correction not just possible, but probable. And this right here is the final, crucial point from the source material. This is not a prediction about tomorrow or next week or even next year. The analysis makes no claim about knowing the timing. The conviction isn't in the when, but in the that. The simple belief that the cycle will, eventually, inevitably, turn. And this leaves us with a really provocative question to think about. In a world that's so focused on the here and now, on the latest quarter, the latest headline, have we become conditioned to just ignore these long-term cycles? Have we started to believe that the recent good times will just continue forever? It's a challenge to all of us to consider whether the lessons of history still apply, even to an asset as solid and as stable as the very land beneath our feet.